Hi, welcome back to this course on infrastructure finance. This is lecture 40 and this will be the final lecture in this course, and we will continue our discussion on the context of infrastructure development that we have been seeing so far in the last couple of lectures. And before we actually do that, let us try and discuss the questions that we had in the previous lecture. So, we had two questions. The first question was what would be a preferred PPP model in roads, whether it is going to be the BOT toll roads or is going to be the BOT annuity. So, if we recollect, we broadly saw that there are two types of PPP approaches in the road project. So, PPP in roads, most of them can be classified into the two categories, BOT toll and the BOT annuity. Now, I am talking about this terminologies with specific reference to the Indian case. If you look at worldwide, they may not really have a BOT toll or a BOT annuity, it might be referred to by a different name, but for the purpose of this course, let us try and stick to what is the common language that is prevalent in India. So, what is the major difference between these two? In a BOT toll arrangement, the private investor gets his revenues by way of charging tolls to the users of the road. I mean, there are other sources of revenues as well, such as land development rights and so on, but primarily the major source of revenue is going to be by way of toll collections. So, this means that there is an expectation that there is going to be substantial traffic flow in the road, and the traffic projections could be easily done, and this road is going to play a major role in terms of boosting the economy, and therefore people are willing to pay to travel in that road and so on. Now, let us look at the BOT annuity approach. In a BOT annuity approach, the government actually pays the fees to the private investor in the sense that it is going to be very difficult to either estimate the traffic flow and thereby the toll collections, or second, the people who are actually using the road might not have the wherewithal to actually pay the toll collections. There might be a lot of resistance from the users of the road to actually pay the toll collections. And in spite of that, if the project charges a toll, then there may be no users for the road. So, therefore, it can actually prevent economic development from happening if a toll is being charged on the users. So, therefore, the government normally decides in such cases not to actually charge any tolls on the users of the road, but instead provide an annuity kind of a payment to the private investor. Now, what is an annuity payment? We have seen it in the beginning of this course. Annuity payment is a payment that occurs at regular intervals, and the payment is determined upfront. So, the payments are equal and it comes at specified intervals in the future. So, that is an annuity payment. So, we see this kind of an arrangement where the economy is not well developed, and the road can actually play a very important role in catalyzing economic development of the region. For example, if you look at poorly developed regions such as the northeast, we do not really have many toll roads, right? Most of the roads are actually laid by the government, and when the government does not really have the capital upfront, when the government is not able to invest as much amounts as needed, then it can actually bring in a private operator. So, the private operator puts in the investment upfront and the government repays the private investor over a period of time. So, that is basically the difference between the BOT toll and the BOT annuity kind of a road. Now, the question is what will be a preferred PPP model between these two approaches. Now, it depends on what is it that we are trying to achieve in a PPP approach. If you are trying to achieve risk management in the sense that the private investor should actually bear an adequate amount of risk, then the toll road will be the most appropriate approach, because in the toll roads the private investor assumes a responsibility of the traffic risk, he assumes a responsibility of revenue risk and so on. So, in terms of having the risk transferred to the private sector, a BOT toll road will actually have a higher rank as compared to BOT annuity kind of an arrangements. In fact, if you look at from the government's perspective, the default PPP arrangement is always a BOT toll roads option. Only when the toll option does not work out will the government look at the BOT annuity option. In fact, there are recent policy guidelines that actually indicate a clear shift towards the BOT toll and minimize the actual use of BOT annuity arrangements. Now let us go to the second question that we had in the previous lecture, and the question was, unit road costs of PPP projects are lower as compared to public sector projects, but the regression estimates indicate an increasing impact of PPP on road costs. How can we actually explain that? Okay. So now we need to understand a little bit about road projects, and the first term is the unit road costs of PPP road projects. What do we actually mean by unit road cost? Let us say if you look at a cost of a road project, cost of a road project is dependent on so many factors. Mainly it is a function of the length of the road. Okay. If the road is of a longer length, then obviously it will cost more of as compared to a road project which is of a shorter length. So, it is a function of length, and it is also a function of the width of the road, right. If there are 6 lanes in a road, that is going to be more expensive as compared to a 4-lane road, right. So, a function of length, lanes. It is also a function of the terrain through which the road passes through, right. If it is a very hostile terrain, if there is a lot of mountains and the mountains rock needs to be cut and so on, it is going to be more expensive. Similarly, if there is going to be more bridges that needs to be constructed, again it might have to be more expensive, right. And it also depends on terrain. So, there are so many factors, okay, that determine a cost of a road project. So, therefore, we cannot directly compare costs of two road projects and then make any conclusion, simply because of the fact that the 2 road projects might have very different characteristics, and therefore, it might be inappropriate to compare these 2 road projects. So, to actually compare 2 different road projects, we need to have exact road projects that are very having exactly the same characteristics, and in real life you may not be able to find such projects, 2 projects having the same characteristics. So, we need to actually find out some ways in which we can actually compare road costs. So, if you assume that most of the road costs are influenced by the length and the lanes, okay, so then we need to compare unit cost of a road project. That means how much does it cost to construct a kilometer. If you assume the unit is a kilometer, how much does it cost to actually construct per kilometer per lane of road. So, unit cost is therefore is nothing but cost per kilometer lane of the road project, right. So, this is your unit cost, this is how much cost to construct a kilometer lane of a particular road. Now, the first part of the question indicates that if you compare the unit cost, of a PPP project vis-a-vis a public sector road project, right, public sector road project. So, you find the unit cost of a PPP project to be lower as compared to a public sector project. A public sector project has a higher unit cost. Now, people might actually come back and say that, oh, actually this is as per expected trend, private investment is supposed to bring in a lot more efficiency, and therefore, having a lower unit cost for a PPP road is nothing surprising, it is as per expected trend. So, there is nothing that we need to be excited about, this is as per expected trends. But the second part of the question indicates that the regression modeling seems to indicate an increasing impact of PPP on project costs. Now, how do we explain this? So, this is where I am going to explain some of the research that we have done at IIT Madras, and hopefully this explanation will also help you to understand a little bit more about the context of road development in general. So, what the question states that if this is the case, then a regression analysis should also substantiate the fact that PPP will result in lower project cost, but the regression analysis seems to indicate otherwise. What could be the reasons for this? So, now we will look at some of our research findings to see why it could be the case. Okay, I am actually going to show a small table that compare PPP and non-PPP road projects. Okay. So, basically we will try and compare this on 3 different dimensions. So, this is called as the variable. Okay. So, if you really look at it, you have the variable, and there are 3 different variables that we are comparing the PPP and the public project. The first is your road length. And what we have done is I have actually given the median values for each of the 3 variables, simply because of the fact that the variables did not actually have a normal normal distribution, and there was a slight skewed. So, therefore, we actually used comparing median rather than the mean. So, if you look at the median, the road length of a PPP project is about 73.114 kilometers, but if you look at a public sector project, it is 39.467 kilometers. So, essentially if you look at it, PPP projects are actually much longer road stretches as compared to public sector road projects. So, that is the first difference that you should be aware of. Normally PPP roads are much longer as compared to a public sector road. The second is your total project cost, that is how much does it actually take to construct that particular stretch of road, and the total project cost is 5837 million for a PPP project, whereas it is 3219 million for a public sector project. Now, this is nothing very surprising about it, because of the fact that PPP roads are obviously longer and the cost also is going to be longer. So, therefore, the cost is higher for a PPP project as compared to a public sector project. Next, we actually look at the unit project cost, which is what I was mentioning, the unit road cost. If you look at the unit project cost, the PPP projects are actually having a lower unit cost as compared to a public project. A public project actually has a higher unit cost. Now, the first impression that you might actually get is obviously PPP is more efficient, and therefore, they are actually having a lower unit project cost. Now, but we also need to remember that when we are trying to attribute what could be the reason for having a lower cost, one could be the economies of scale. So, that is as we actually construct a road of a longer length, the unit cost becomes lesser and lesser. Let us say for example, this is your length and this is your unit cost. Right. So, if we actually have the unit cost to be the same, irrespective of whatever the length is, then it will be just a straight line, right. Whatever the length of the road is, the unit cost is the same, but in real life you do not really see such a trend. Most infrastructure projects which actually exhibit economies of scale, the cost reduces if the capacity increases. So, therefore, if the length increases, the unit cost can actually come down. So, this is your economies of scale, right. So, if the length increases, the unit cost can actually come down. So, this is your economies of scale effect. So, if you consider the economies of scale to be prevalent in road construction, then what you might actually feel that yes, because public PPP roads are longer, the unit cost is also lower. Okay. We also look at some other differences between the PPP and the non-PPP road projects. An important variable in construction projects is to really look at overruns. Okay. So, overruns can be in 2 dimensions. One is there can be overrun in terms of cost, that is the final cost of the project will be higher than what was actually initially estimated. So, that is called as your cost overrun, or the overrun could also be in terms of time. The actual time it is taken to implement the project was higher as compared to what was estimated. So, that is your time overrun. So, essentially overrun is in terms of how much was the actual different from what was initially estimated. Right. So, in most cases overruns are positive, that is, the actual is more than what was estimated, but there are instances where the overruns are negative, that is, the project has been implemented faster and it has been implemented at a lower cost than what it has been budgeted. So, technically speaking, overruns can be either positive or overruns can be negative. Now, we try and look at the overrun numbers on PPP and the public sector projects to also determine how efficient the PPP has been. So, if you really look at the cost overrun in PPP projects, the cost overrun has been 104.66 crores, whereas in the case of non-PPP the cost overrun has been 23.94. So, there has been a substantial difference in cost overrun, right. PPP projects have a higher cost overrun as compared to non-PPP projects. So, if you really look at the fourth column gives you the results of the statistical tests done to find out whether the difference in the means is actually statistically significant. Remember, we cannot simply conclude a trend by looking at the means simply because the fact that the mean might not be a good reflector of underlying trend. Okay. So, we need to really check whether the difference in mean is actually statistically significant, and when we do a statistical test we find in the case of a cost overrun the means are statistically significant. So, that means the cost overrun in a PPP project is higher. Next, we also look at the average percentage of cost overruns, right. Average percentage of cost overruns is nothing but the total cost overruns divided by the total project cost. Again, the average percentage of cost overrun is higher for a PPP project as compared to a non-PPP project, and the difference is statistically significant. Now, let us look at the time overrun, that is, how much it is actually taken, how much more time it is actually taken to complete the project as compared to what was budgeted. If you look at the time overrun, non-PPP projects actually have a higher time overrun as compared to PPP projects, and if you really look at the average percentage of time overruns, again non-PPP projects have an average higher number as compared to a PPP project. Now, if you really look at it, in both the cases of time overrun, the difference is statistically significant. So, one interesting trend that you may actually observe is that the opposing tendencies between the cost and time overruns. If you look at the cost overrun, PPP projects have a higher cost overrun, but if you look at the time overrun, public sector projects have a higher time overrun. So, there are some differences between PPP projects and public sector projects. We cannot say that PPP is actually better in all dimensions as compared to public sector projects. In some dimensions it may be better, but whereas in other dimensions the public sector projects might be better off. So, that is the first thing that we have to realize. PPP is not a cure for all the ills that prevail in the system. It helps to bring in certain amount of efficiencies, but it may not be able to remove all the ills that we see in the system today. Next, we have what is called as certain amount of economic variables. Okay. So, these variables help us to understand the other factors that influence private sector investment in the road sector or in general in any infrastructure sector. Right. So, the first variable is your project duration. If you look at it, project duration of a PPP project is higher as compared to a non-PPP project, and the difference is statistically significant. Right. So, that means PPP projects are bigger, and therefore, the duration of the project is also longer. So, it is actually in confirmation to the existing trend. Then we look at time lapse. Okay. The time lapse indicates that how much time it is actually taken from as compared to a particular base year. Right. And more is a number for time lapse. We find that the inference is that most of the project has been recent. So, therefore, if we really look at it, the time lapse 38.33 months for PPP project as compared to 15.86 in the case of non PPP project. So, what does it indicate? This indicates that most of the PPP projects has been implemented in recent years. There is a growing trend of road projects being implemented in PPP as compared to public sector. And this also indicates that private sector is actually getting a lot more comfortable in implementing PPP projects in the road sector in India. So, essentially this kinds of indicates that time actually plays a very important role. In previous in earlier years of the study, when there was very little experience of having private sector participation, there was not much of investment coming in, but with experience, the government getting experience, with the private sector getting more experience, and with the growth in the economy and so on, today there is a lot more comfort for the private sector to invest in the road sector. Next we will look at certain contextual variables. Okay. So, this contextual variables is another indicator as to what are the different factors other than the project characteristics or other than the economic characteristics that can actually play a role in influencing private sector investment. The first variable that we have under this category is called as your per capita real GDP. So, per capita real GDP indicates what is called as the underlying development. It also indicates the underlying wealth of a particular state. If the per capita real GDP is high, so that means the state is well developed. The people are generally comparatively more richer as compared to states with lower per capita GDP. Now, if you look at these two the per capita real GDP for PPP projects and non PPP projects, you actually find PPP projects have a higher per capita real GDP. So, what is the inference? The inference is that private investment actually happens in those states which are having a higher per capita GDP, and the difference is significant. So, that means if states economic potentials, the state's economic level or the economic status plays a very important role in attracting private sector investment. States that are more prosperous, states that are doing better are having a higher probability in attracting private sector investment. The second context variable is what is called as your infrastructure index. Okay. So, the infrastructure index indicates the level of infrastructure development in the particular state. Okay. And we need to want to check out whether the existing infrastructure level and capacity plays a role in attracting further private sector investment. So, if you actually look at it, the infrastructure index is not very different between PPP projects and non PPP projects. So, the statistical test also does not indicate any significant difference. So, that means the existing level of infrastructure in the state does not seem to play any role in terms of attracting private sector investment. The prosperity of the state matters, but it does not really matter what is the existing state of infrastructure in the status. And the third is your property rights index. Now, the property rights index is taken to indicate the level of protection for private property in the state. Okay. That means how much the state government is willing to protect the property rights of the private investors. So, if the property rights index is very high, so that means the private investors feel that their investment is more safer from governmental action in that particular state. So, if you look at the property rights index, it is of a higher value in the case of PPP projects as compared to non PPP projects, and the difference is statistically significant. So, that means what? Private investment actually flows in those states which can actually give a higher protection of property rights to the private investors. This is natural, and the inference from this finding is that states that are desirous of getting private sector investment should be should actually facilitate higher property rights protection for the private investors. So, if they are able to do that, then they will be able to attract private sector investment as compared to otherwise. Okay, now I will present the results of the regression estimates. Okay. The first regression estimates is on unit cost. Okay. So, remember when we looked at the previous comparison of unit cost between PPP and non-PPP projects, we found that there is a significant difference in the unit costs of PPP projects vis-a-vis public sector projects. Now, we are trying to do a regression estimate on unit costs to actually determine whether the difference in unit costs is because of PPP or because of how we actually procure the project. Remember, we talked about the cost of a road project as a function of different variables, different dimensions. We need to know whether PPP actually plays a role in reducing unit costs. So, one way to actually do it is to do a regression of different variables that can actually impact project cost. Okay. So, in this estimation we have used the following variables. So, we have actually used the length of the road. We have known that the project cost are actually determined is based on the length of the road. So, we looked at length, which is called as your log length, and then we have a structure type. So, remember roads can actually be a plain road, or there can be different types of road projects. It can be like flyovers, it can be road over bridges, it can be bridges and tunnels and so on. So, each of them have different types of cost structure. A tunnel is going to be far more expensive as compared to a road project. So, we need to differentiate between projects of between different types of road projects. So, therefore, we have used this variable called structure type. Now, structure type is more of a dummy variable, that is it takes a value of 0 if it is level road, and it takes a value of 1 if it is having complex structures like bridges, tunnels and road over bridges, flyovers and so on. The third variable that we have is your MLA funding, and this is your multilateral agency funding. Okay. When we actually have funding from multilateral agencies like the World Bank or the Asian Development Bank, what actually is the impact on project cost? Does funding from multilateral agencies reduce or increase project cost? So, that is what we need to find out, because these agencies actually have provide capital at very low interest rates. So, therefore, technically speaking, these agencies should be this presence of this agency should actually reduce project cost. Whether this is actually the case, we needed to find out, and that is why we included it as a variable. Okay. The fourth is always your procurement type. So, this again is a dummy variable which takes a value of 0 or 1. So, this is the variable where we test the impact of PPP, right. So, we assume that the project can be procured by one of the two ways, that is it can be a PPP project or it can be a public sector project, right. When the procurement type takes a value of 0, so that means it is a public project, and if it actually takes a value of 1, then it actually has a PPP project. So, this will tell the coefficient will tell the impact of using PPP on unit project cost. And then we talk about time. So, a time indicates when the project has been implemented. It actually accounts for the time factor, whether the projects have actually been more expensive in recent years as compared to the previous years. So, that is the time factor. And then we have what is called as your project type. The project type can be let us say a greenfield project, or it can be a expansion, it will be a totally new project, or it can be a project expansion, or it can be a renovation. So, this actually gives you, this variable is used to capture for that. And then we have what is called as your density growth. So, that means we looked at road network density of a particular state and how it has actually grown over a period of time. and this density growth is actually is to indicate the level of road development in that particular state and whether the existing road development actually plays any role in the unit project cost. And finally, we have what is called as your variable for corruption. Corruption indicates how much indicates the level of corruption that is prevalent in the states, in the government, and we wanted to check whether this actually plays any role in unit costs. So, after doing the regression estimates, we have the coefficients for the different variables that we have just described. So, if you look at the coefficient for log of length, the coefficient actually has a negative sign, and the variable is also significant. The coefficient is also significant. So, this indicates that as the length increases, since the coefficient has a negative sign, therefore, the unit cost will reduce as the length increases. So, this clearly demonstrates the economies of scale effect. If you really look at a structure type, my structure type actually has a positive coefficient. Remember, structure type is a dummy variable. It takes a value of 0 if it is a level road, and it takes a value of 1 if it is a complex structure. Complex structures are naturally going to be more expensive. So, therefore, the structure type variable having a positive coefficient indicates and validates the fact that when we actually have road over bridges or tunnels or flyovers, it results in an increase in unit cost. Then we actually have multilateral agency funding, and multilateral agency funding again has a positive coefficient, which indicates that when we have funding from multilateral agencies, it tends to increase the unit project cost. Okay. So, this in a sense is probably a surprising finding, but the rationale behind this could be when we actually have funding from such institutions, they actually put in place a lot of processes, and say for example, there has to be adequate amount provided for resettlement and rehabilitation of people and so on and so forth, which can actually increase your project cost. So, that could be the rationale, this variable having a positive coefficient. And next we come to the variable which is of interest to us, which is your procurement type, and the procurement type again has a coefficient which is positive. So, that means this is a dummy variable which has a value of 0 for a public sector project and a value of 1 for a PPP project. So, therefore, if this variable takes a value of 1, this actually results in an impact of increasing the unit project cost, because the coefficient is positive. If the coefficient has been negative, then a PPP would have actually resulted in having a lower unit project cost, but because the coefficient is positive, we actually find that PPP actually leads to an increase in project cost. Then time again is positive, and the value is also significant. So, that means with the increase in time, the unit project cost is actually increasing. So, therefore, the improvements that we could have achieved over a period of time by way of gaining more and more experience does not seem to be reflected in the project cost. Project cost seems to be increasing in recent time. And then finally, we look at the corruption variable, because the project type and the density growth is not really having any statistical significance. If you look at the corruption, again we are seeing a positive coefficient. That is, though the coefficient magnitude of the coefficient is very small, it clearly indicates that when the levels of corruption are higher in a particular state, it also tends to increase the unit project cost. So, therefore, for a state government this is very clear. Any tightening or any increase in governance can actually play an important role in terms of reducing costs of infrastructure projects. So, now let us discuss. We have seen in this regression estimation that PPP projects tend to increase unit costs, but earlier we actually see that unit costs of PPP projects are actually lower. So, how can we actually explain the difference? So, the difference can be explained by the fact that we are talking about unit PPP costs being lower there simply because the private sector is taking advantage of the economies of scale. They are simply better positioned to manage larger projects as compared to public sector. So, public sector does not seem to have the management capability to implement longer projects, but if you compare like to like, that is, if you compare two projects of similar stretches, then public sector seem to have a better advantage in terms of unit cost as per our estimation. Right. So, the real impact of having private sector participation in the roads is in terms of bringing in private sector management capability and efficiency. Because of this higher levels of management capability, the private sector has been able to build longer road projects as compared to public sector. Next we will look at the impact of PPP on time and cost overrun. So, the results that I have shown here is a truncated regression, because we had several variables. So, therefore, I have kind of showing only those results that are interesting for our discussion. So, this regression indicates the regression estimations on cost overrun and time overrun. So, this actually is a 3-stage least square regression which we have done to account for the dual causality between time overrun and cost overrun. Let us say, for example, we always observe that whenever there is a time overrun, it invariably leads to cost overrun, and sometimes whenever we have cost overrun, it can also result in an increase in time overrun. So, these two variables are interrelated. So, because of the fact that they are interrelated, we cannot do a simple regression, we have to do what is called as your 3-stage least square regression to handle what is called as your simultaneity bias. Nevertheless, we can try and interpret the results in the same manner that we did for the simple regression. So, the first regression is on the cost overrun. So, when you actually find the regression on cost overrun, and we looked at 4 variables, we have time overrun, we have cost overrun, and then we have project duration, and then we also have DPPP. So, DPPP is the dummy variable to indicate whether the project is PPP or not. Okay. And if the project is PPP, it actually takes a value of 1. If the project is not a PPP, then it actually takes a value of 0. So, in the regression equation on cost overrun, you actually find time overrun is significant and the coefficient is positive. So, that means an occurrence of time overrun actually increases the cost overrun. Okay. Whenever there is an increase in time taken, whenever there is an increase in time taken as compared to what was budgeted, it also tends to increase the project cost. Second variable is project duration. The project duration coefficient is again positive, and the coefficient is significant. So, that means as the project duration increases, it tends to increase the cost overrun. That means long duration projects have higher cost overruns as compared to short duration projects. So, this is also as per what we tend to expect, in the sense that in complex projects have a higher tendency of incurring overruns. And then we talk about the PPP variable. The PPP variable is interestingly having a positive coefficient. So, that means PPP projects having a higher probability of cost overrun, right. PPP projects are associated with higher cost overrun as compared to non-PPP projects. This actually supports the results that we have seen in the earlier means comparison. Remember, when we looked at the earlier means comparison, in this table we find that PPP projects are actually having a higher cost overruns. Next, we look at the regression estimation on time overrun. If you really look at the regression estimation on time overrun, you do not find any variables that is of significance. Okay. Cost overrun coefficient is negative, but it is not significant, and project duration is positive, but again it is not significant, and the variable DPPP is again positive, but it is not significant, in the sense that a PPP project has a tendency to have higher time overruns, but it is not significant. So, we cannot really attribute causality to PPP in the case of time overrun. So, what we can actually conclude is follows: there seems to be no significant difference between PPP and non-PPP projects in the case of time overrun, but PPP projects definitely have higher cost overruns as compared to public sector projects. So, all said and done, we still need to find out better ways of implementing PPP projects, simply because of the fact that there is a need to actually control cost overruns in the case of PPP projects. Okay, now we will quickly try and summarize the last few points of this course. First is there is a significant demand for investments in infrastructure assets around the world. I mean, whether we it's kind of universally understood that there is going to be a lot of demand for infrastructure in the coming years, and there may be discrepancies in terms of how much is actually investment. For example, one study might actually give a different number, the other study might actually give a totally different number, but nevertheless there is complete agreement that the investments needed in infrastructure are significant. And it is also kind of a general agreement that there has been an imbalance between supply and demand. Like say for example, the imbalance has been created by various events. For example, there has been an economic upturn, so therefore there has been a sudden increase in demand for infrastructure assets and so on. And second is throughout the last several years we have actually not made investment in infrastructure as needed. There has always been a shortfall in the investment that is made in infrastructure. So, this shortfall has built up over the years. And third is there has been inadequate maintenance of existing facilities. Whatever investment is being made is basically in terms of construction of newer and newer facilities. There has been very little attention being given to the maintenance of the existing facilities. So, because of this there has been an imbalance of supply and demand that has actually widened over the years. So, World Bank has made some estimates in terms of the demand for investment in infrastructure, and it is at about 2.2% of the global gross national product. So, this is both for new investments as well as for maintaining the existing facilities. So, this is a very large number in terms of demand. Okay. The other trend that is being seen across several countries is that the government spending on infrastructure is declining as a percentage of GNP. Right? There can be various reasons why it is actually happening, but both in developed countries and in developing countries over the last several years, the government spending in infrastructure has shown a declining trend. Again, there are several predictions that have been done by various studies. For example, one very prominent study done by OECD in a report titled called Infrastructure 2030, it estimated that the global investment need in infrastructure between 2007 to 2030, and so talking about approximately 25 years, is about 60 trillion. So, 60 trillion is a fairly large amount of money that that is being projected, right. And if you are looking at developed countries, the OECD member countries, and they are expected to invest about 500 to 600 billion a year in electricity, road, rail and water supply over the next 25 years. So, it is each and every year we are talking about investment of 500 to 600 billion, which is a substantial amount of investment envisaged in the next 25 years. Another secular trend that has been seen is that the share of private infrastructure investment have steadily increased in recent years. We are talking about government infrastructure spending coming down, and at the same time the share of private sector investment is increasing. If you look at the type of infrastructure investments, they can be broadly classified under the following heads. So, when you have infrastructure project companies. So, infrastructure project companies are, let us say, they have a specific project to operate. It can be a particular toll road, it can be a particular plant, and then the life depends on the project. So, these kinds of companies have a defined lifetime. So, for example, for a toll road company, and the life of the project is over when the concession period expires. Similarly, for a power purchase, for a power plant, the life of the project is over when the power purchase agreement expires and so on. So, these are all infrastructure project companies. Okay. So, they are essentially operating infrastructure projects, but they actually have defined life. Then next you have infrastructure operating companies. So, these are companies that are very similar to a conventional corporation. That means these are ongoing concerns. They do not really have an end life. They are supposed to operate forever. So, an example for such an infrastructure operating company could be the BSES, the Bombay Suburban Electricity Supply in Bombay. So, this is actually a private sector entity, and they actually provide electricity supply to consumers in Bombay, and there is no end life to that. So, they are supposed to be operating forever. So, that is an example of an infrastructure operating company. I mean, there are several infrastructure operating companies in the public sector. right, where they are not tied to a particular project life. And we are now seeing several such examples in the private sector as well. Next we have what is called as our infrastructure service companies. So, infrastructure service companies are those that provide actually service to the infrastructure sector. Now, it could be, for example, providing construction service to the infrastructure companies, it could be in terms of providing facilities management to the infrastructure companies and so on. So, they do not directly, let us say, own or operate infrastructure assets, but they actually provide some kind of service to the companies that are operating in the infrastructure sector. Next is we have broadly any infrastructure project being classified. You are talking about infrastructure projects here being classified into two different categories. One is a greenfield investment, the other is your brownfield investment. Let us say if any project is developed from scratch, it is completely a new development in terms of planning, development, design, construction and so on. If it is a completely new project, then it is called as a greenfield investment. Okay. On the other hand, if the project involves, let us say, a renovation, refurbishment or expansion of an existing facility, then it is called as a brownfield investment. Okay. And an example of a greenfield investment is your Bangalore International Airport project. So, there was an existing airport in Bangalore which was a smaller capacity, and when the new airport was being constructed in Bangalore, they actually decided to construct in a new location. So, this was a completely new project. So, that was a greenfield project. On the other hand, if you look at the airports in Mumbai and Delhi, this involved expansion of the existing facilities. In the case of Delhi, it was constructing a new terminal in the existing airport location. Similarly, in the case of Mumbai, it was an expansion of the existing airport. So, therefore, these are all brownfield investments. Okay, similar to the case of Chennai. Chennai again they are trying to build a new terminal in the existing airport location. So, that is a brownfield investments. So, we need to be aware of the difference between a greenfield investment and a brownfield investment. Why? Because the levels of risk in a greenfield project are supposed to be a lot higher as compared to a brownfield investment. Why? Because in a greenfield investment there are several things that needs to be acquired for the first time. For example, we need to actually get several permits, we need to have environmental clearances and so on and so forth. In a brownfield project, many of these clearances would have already been obtained. So, to that extent, the time taken for getting some of this is going to be lower. Second is the kind of big problem today we have in infrastructure project, which is in terms of land acquisition, might not really be as big a problem in the case of a brownfield investment, simply because there may be existing land available alongside the project, and may not be any need to acquire fresh land. So, in terms of risk, brownfield investments have a lower risk profile as compared to greenfield investments. Okay, finally, we need to recognize that today infrastructure is seen as a separate asset class. Okay, what is an asset class? So, really look at investments. Investments can be in different types of assets. So, for example, if you look at real estate, you can look at stock markets, you can look at bond markets, you can look at timber, you can look at commodities. So, there are different types of asset classes. And today there is a realization that infrastructure is emerging as a separate asset class. Why? Because it is having the following characteristics. It is supposed to be it actually has characteristics of inelastic demand. That is, even though a price might increase, the demand for infrastructure product or a service might not actually reduce so much, because people see it as an essential service for day-to-day life. And second, infrastructure sector is supposed to have stable and foreseeable income streams. In many of the cases, there is a long-term agreements. In the PPA, there is a long-term power purchase agreement. Sometimes we may be able to predict the traffic in a particular road, for a longer duration. So, the income is not as risky as we see in the conventional sector. It is very stable and foreseeable. And third is it acts as an inflation hedge. It acts as an inflation hedge simply because the revenues are frequently linked with the changes changes to inflation. So, whenever the inflation increase, the toll charges also correspondingly revise. So, it acts as an inflation hedge. and fourth is there is little correlation to other asset classes. So, that means it actually helps to diversify the investment portfolio. Remember, one of the important thing in the financial in finance is the relationship between risk and return. So, if the risk increases, then the investor should be eligible to get correspondingly higher returns. Diversification helps to reduce the risk while maintaining the level of returns. So, that is very important to understand, and infrastructure is essentially helps to diversify. Let us say, for example, now you talk about, let us say, an efficiency frontier without infrastructure, right, without infrastructure assets. So, this is efficiency frontier for a portfolio of asset for a given level of risk and return. Now, if you actually have infrastructure in the portfolio, and then it can actually become something like this. So, what we actually see is that for the same level of risk, infrastructure might actually give a higher return, right. Diversifying an infrastructure might actually give a higher level of return as compared to not having any diversification in infrastructure. So, people see this as a good way of diversifying diversifying risks, because of the fact that it has very little correlation to the other asset classes. But more recent research has indicated that it may not be really a totally new asset category, but it actually has characteristics that is a hybrid of real estate, private equity and fixed income asset categories. Fixed income asset categories is like your bonds, and then we have private equity, which is actually making high special category of institutional investments in the unlisted infrastructure sector, and then we also have real estate, which we are all familiar, which is investing in property. But at the same time, infrastructure cannot be considered as a subcategory of existing asset classes. So, what we actually see is it may not actually have an entirely new characteristic. It is a hybrid of real estate, bonds, fixed income and private equity categories, and at the same time it is really different that it cannot be considered as a subcategory of some of the other existing asset classes, right. And results have also indicated that having infrastructure in the portfolio of investment increases diversification and also reduces your risk return portfolio. Remember, this is what I have been talking about. Having infrastructure increases your return, but at the same time reduces your risk, or for a given level of risk it increases your return. So, because of all of this, infrastructure is emerging as a very important asset class for several investors. For example, many of the pension funds in Australia and Canada are having significant percentage of investment in infrastructure assets. Okay, so the prospect is very clear. There is a lot of investment that is needed in infrastructure, and we are going to see increasing levels of private sector participation, and investors are also seeing benefits of investing in infrastructure assets simply because it helps them to diversify and helps to improve the risk return profile. So, with this final thought, I am going to end this lecture, and if you have any questions that is probably not been addressed in this course, feel free to email me at this email address, and with this I thank you and wish you the very best.